So when we read the news and the media, we hear many opinions on the economy and the stock market. So there's many discussions on how the economy is performing, the global economy and the economies of different countries. And there's a difference between what the economy does and what the stock market does. Typically, the stock market will have built in the expectations of the economic recovery and the pricing. However, what we're seeing right now, which many of you may have thought of in the face of the recent developments and volatility in the investment markets, is the economy does not have very good expectations of growth, of solid growth in the near future, at least. And there's a lot of uncertainty as it pertains to how the COVID crisis will be resolved and when a vaccine will be available and how that is going to be distributed and what that means in terms of the spread and containing it meanwhile. And so while we have these thoughts about the economy, we can very well see that the stock market has recovered very well from what we experienced mid-March of this year. In that, especially for our clients, all of our clients' portfolios now have positive returns as of last year and as of this year so far. But what that means also is with the low interest rates that I mentioned earlier, there's a lot of money available at a very low cost. And so the corporations are taking advantage of this. And what they're doing is they're buying back their stock. And this is making the stocks appreciate in value. And that's why we also see a higher recovery in the stock market. There are also many people who got very scared during when COVID first hit us. And in the course of that period, in the course of March and April, a lot of investors took that money out of investments and they put that money in money market funds around the world. However, they are seeing now that there's a recovery, especially in the technology stocks in the US. And for fear of missing out, they're trying to jump back into the markets. And so there's all this money going back into the stocks that has been parked so far. And there's also sector differentiation in what has been recovering in the stock market and the type of companies that have done well since the slowdown in March, and the type of companies that may have recovered or did not recover very well. So we're seeing a differentiation in sectors such as travel, which we don't expect to be doing well for a long time. We're seeing companies such as Hertz, very well established and well-known companies, or Neiman Marcus, who went out of business. And we're also seeing companies like Amazon and Netflix and Google and Microsoft perform really, really well. And so there's a difference in, depending on what each of you has been invested in, you're probably going to see differences in the type of stocks you own. There's also a huge difference between performance and recovery of Canadian stocks versus US stocks. And so while the economy still doesn't have high expectations in terms of a solid recovery. So with that in mind, what should any investor think of at this point in time? Flu season is ahead. We don't know if the other shoe is to drop or not. What do we do in terms of our individual investment plans? Well, my first question for each of you is, I don't know if any of you have a financial plan or not, but I would certainly suggest to look into getting a financial plan in place. For those of you that have an investment and a financial plan in place, my question to you to ask your advisor to think about is, have your goals been impacted? For many of my clients, when I meet with them and I go through all the numbers in our portfolio, I always revisit the first reason why they came to us for investment advice and the goals that we discussed and we shared and we invest by. And so it's very important that after a crisis of this nature, to ensure that you are on track to still reaching the goals that you have set out to reach within the time frame you anticipated. And especially now, it's important to revisit and find whether you need to take any mitigating action or if you're still on track, or how this will impact you in the long term or for the time period that you intend to be invested. Two other things come to mind when thinking of impact: how liquid your portfolio is, as well as the timing of any impact that may have in any plans that you may have to take some of those funds out. Or I don't know if you rely, sometimes some of my clients rely on their investment portfolios to support their retirement income. And so the timing of these cash flows may also affect what your whole portfolio does, especially in a post-pandemic world, much more so after a certain period of rising stock prices. And so it's important to revisit all of these points with your investment advisor and try and get some clarity as to whether you are still on track to reach your goals. Typically, when I meet with my clients, these are some of the things that I touch on. There's a roadmap to managing wealth, and we start the process when we get a new client on board by building a plan around their assets, their liabilities, and their life goals. And it's very specific. Each portfolio we build is structured for that particular person. We have a very solid process, and that's one of the things to look for in choosing an investment advisor, a very strong investment process that is very simple and easy to explain. In investing, we invest in conservative companies. We do not take extraordinary risk because we're not looking to get extraordinary returns from our clients. We invest in very high quality equities. And in the process of doing our due diligence, we also avoid the tragic in picking stocks that may have not been in business long enough. I mean, some of the companies that invest in marijuana come to mind, that for a certain period, the stock prices reached extreme highs. However, there's no earnings to support those stock prices. So we would never invest in things of that nature, as an example, or Tesla for that matter, because we don't feel that that stock price is supported by their earning or their business at this time. And so in not taking risks of that nature, we are not participating when those stocks go up in value so much. And we're okay with that because in the process of doing so, we understand what we're investing in and we prevent something tragic from happening and losing all the clients' money. So in that particular order, again, what's important here is that your investment plan and your financial plan be built around your assets, your liabilities, and your life goals with those three components in mind. In growing assets, the three important components here are the time, discipline, and good wealth advice. The time in the market is extremely important. Nobody knows what the market is going to do in the short term. No one could have predicted the impact of COVID or that COVID would have happened. And so this, however, is a short-term event. And in the long term, stocks have a history of relentlessly going up. And so in doing so, it's important to have the discipline to get through these market slumps and stay invested in the long term, because that's when we see the growth in the portfolios. Typically, with the type of conservative companies we invest in and being more heavily invested in equities versus bonds, we expect that over 10 years, the size of the portfolio will double. And so you need good wealth advice to accomplish this, and to accomplish this in a way that we do not take a lot of risk in that time period, and achieve those sustainable results in the long term, and have the discipline to live through the markets and step away and not sell, especially when the markets go down. So in terms of time, I want each of you to answer these questions for yourselves. How do you feel you reacted during the COVID crisis when all the stocks dropped in value? Did you feel that you're looking at your portfolios more frequently than other times? How regularly do you typically assess your returns? And how did you feel about your portfolios when all the stocks dropped in price in March? At the end of the day, whatever happened in March is, at this point in time, a point in history. And the only real time horizon that counts when investing is the long-term horizon. Just like when we own a house, we do not care to know what the price of the house is on any given day of the year. It's also important to view a long-term investment portfolio the same way, in that the value only matters when you're ready to start liquidating the portfolio for that portion that you intend to liquidate. And then liquidity and timing are also very important, because these are conversations you need to have with your advisor when you meet with them, in that you need to inform them what your liquidity needs may be as early as possible, so that when they construct a portfolio for you and they structure it, they take that in mind, so that no one is in a position to do a panic sell of stocks at a time when it's inconvenient and it's going to lose more money for you in the long term. These are some examples of what the stock market did after very severe events that caused a slump in the stock market. And so you have, after Great Depression, an appreciation of 367%. And after the Great Recession in 2008, you had a recovery of 178%. What does this tell us? This tells us that discipline is crucial in allowing your earnings to grow in the long term. And so in getting through the fear of events that may not be anticipated and had a huge impact on your life savings, it's important to note that if you do get out of the market at a time like this, these are the kind of returns that you're going to miss out on, and they're very difficult to, it's very difficult to return in the market and capture these types of gains again. And it becomes more difficult with retirees where that are supporting and supplementing their retirement income through their investment portfolios, and they're liquidating some of it, and the time horizon of the investment portfolio becomes shorter, and so it's the much lower time frame, much smaller time frame to be able to accomplish the same return. So a very small period out of the market will cause you to miss out on all of these wonderful recoveries from the past, and many average investors are actually guilty of that.
Esida, I'm
yes.
going to stop you for a second because I think Joy had a question, and I don't know whether or not she had a chance to, if you saw that, she did signal that she had a question.
Oh, no, I didn't see that. Go ahead, Choi.
Thank you. I absolutely agree that it's a time to find a financial planner, particularly a good one. And right now, and I think we have entered the beginning of a depression, and we have entered a very, very dangerous and turmoil environment, and politically, economically, environmentally, personally, mentally. And you just said, brought out the word inflation, and I've heard another word, stagflation, many times, a lot of the times, like, so a lot of not important assets will deflate, but those are critical survival items like food have already been increasing in price a lot, and the trend will keep going. So we are entering a very, interesting and a period, and we definitely need to protect our portfolio. And now I don't think it's in time to talk about like increasing the value in the portfolio or what. It's time to talk about protection of our portfolio. And
hey, Choi, do you have a question to your comments?
The question, and okay. Yes, I have quite a number of questions, but I was stopped here because right now, and for example, and in terms of paper access, physical access, there are different questions, so there's different groups. So I was stopped here and continue listening, but I would like to remind about this, the word stagflation, not just inflation, and also the need to focus on protection of our portfolio.
Absolutely, and I'm glad you mentioned that, Choi. Thank you for that comment. I'm glad you mentioned that because that's one of the things that I'm focusing this presentation on, and it may not come in the way that you have framed your thoughts as of now. We have our views as to how to protect our clients' wealth in a period of stagflation, which is exactly what I described so far. In the short term, we expect inflation will be low, but in the long term, with all the funds available and low interest rates, which everyone has made clear that they may be low for a long time, yes, that's exactly with a slower economy and a higher inflation, which is what stagflation is. So in this environment, one of the solutions that we have implemented successfully so far for our clients is what I'm going to be discussing in the presentation. It may not, however, unfold to the extent that you've already thought of it. So I'm going to ask you to please keep an open mind and please ask me questions. but that's exactly what I'm going to touch on. So one of the questions that I got from you, loan, is with regards to short-term sources of liquidity. And so I put together a short list of what some of these sources may be. So if any of you have a line of credit with a bank or has other assets with a bank, it's always nice to get access to a line of credit. They tend to be a bit lower interest rates than other sources of short-term debt or using your credit cards. And even if you don't need it right away, it's nice to have open and available and approved before you actually need to use any cash. Another source of liquid assets is the TFSA accounts. And I would like to hope that each and every one of you has a TFSA account because it provides a nice tax shelter for your capital gains to grow as well as your income in some of your investments. TFSAs are fantastic because they also can serve as a source of liquidity depending on what you invest them in that your money will not be taxed when you take it out, and you also don't lose the room in these accounts when you take the money out. Another source of investment of liquidity, which you may not be as familiar with because it's not widely advertised, is for investment accounts. There's always a way to open a margin account where you can borrow at a very, very preferable interest rate from your investment institution, actually from the custodian that your investment funds are held with. So this is another area that you can revisit with your investment advisor to find the availability. Even if you don't need the funds right away, it's nice to have a margin account open. Again, it's a short-term source of liquidity should you need funds that you are able to pay back in the course of 6 months, I would say. For those of you who do have an insurance policy, a life insurance, typically those have cash values. You can always borrow against that, but keep in mind that may lower the benefit at the very end and also needs to be paid back. And there's the cash and short-term bonds in our invested portfolios. Those always provide a short-term of liquidity. Short-term liquidity if you are caught off guard with an expense or something and you do not want to touch your investment portfolios or sell them at an inopportune time. This is another source for you to withdraw funds from. So I'm not sure who asked this question because it came to me from loan, but I don't know if it answers the question or if you'd like to discuss it further.
It didn't come from me. Oh.
All right, I'm going to move on to the next slide. For those of you who do have reliance on your portfolios, investment portfolios, to cover some of your living expenses or cover some of ongoing liquidity needs, it's important to have the discipline in sort of allowing the investment funds to keep growing, but it's also important to have access to those liquid funds when you need them. And there's also sometimes unexpected events that may cause you to need funds. So as a rule of thumb, it's important for all of us to set aside 3 to 6 months worth of expenses in funds in an account that is a savings account. For those of us a bit more conservative, who do not react particularly well to and get more emotional around volatile markets, such as the one we experienced in March, you could also raise cash to cover 1 or 2 years of needs or expenses, and that way you will not panic and you'll have the discipline to go through market cycles without selling assets when all the stocks have dropped in value. It's also very scary to listen to the news at times like that, and it tends to sort of feed on the fears we all have, which sometimes triggers people to sell stocks at the worst time. And so it's important to not listen too closely to the news. They tend to be a bit more tragic. And who would have predicted in March that that we would have had such a recovery of stocks that what we've experienced so far? I didn't hear any news channel expressing that view at all. And it's always, as a rule of thumb, a bad decision to sell after the market has taken a big fall. Just like I showed you a graph earlier, typically an investor who misses the five best days of the stock market between the period here, the 30 years, typically they have lost significant returns in the very long term. And again, no one can time the market. And so we don't want to miss those 5 days whenever they happen to be. And that's why it's important to stay invested. The last pillar of the roadmap to good wealth management is how is your income? And this comes in the form of advice. When we see the stock prices drop in value, bless you.
Bless you.
Thank you.
And we're looking at portfolios that have been built for the purpose of generating income. If you're still secure in the type of companies in your portfolio, if there's still solid companies with solid earnings, with good management, then it's important to focus on the income and not on the daily price of the stock. There's also this long-term view that bonds are safer than stocks. Well, we're now facing a different environment where many of the wonderful companies are just so highly indebted that we don't know whether we are taking a default risk by investing in the bonds of those companies. And so it's also important to note that when we are invested in bonds as to who the issuer of those bonds is and what has happened to them in these economic uncertain times and what has happened to the debt on their balance sheet. And are they truly the quality company? And is that bond truly a low risk investment vehicle for you to be in? Because typically the view is that equities are riskier than bonds. However, with the interest rates being at record time lows, maybe not in the short term, but in the long term, those interest rates are sure to go up. They have nowhere to go but up in the long term. And in that particular case, what happens to the bond prices is they drop. Bond prices have an inverse relationship with the interest rates. Eventually the rates will go up, the bond prices will drop, and if someone is looking on that bond as the safer part of the portfolio, especially the longer term bonds that do not have the credit ratings, especially the ones issued by companies that have increased their debt to an extent that it may not be sustainable. Those are not necessarily safer investments. And so that thinking needs to be updated in terms of what asset class is riskier. And that's the view that we take. The other thing to think about is very long-term bonds will have a return that, let's say a 7-year bond may have a 3% return. What happens to that 3% return after fees, after taxes, and after inflation? How much of that do you truly have left? And is your portfolio really growing and providing you the income you need and the security you need? So these are all questions to consider when you look at the weight of bonds that you hold. What is important to know is also the quality of the equities you have, in that the companies that do pay dividends, are they truly type of companies that have a strong balance sheet where they are able to sustain the higher dividends? And so that is also a very important point to make, and as to whether that management is or is not committed to holding the dividends where they are for the long term. So these are all questions that need to be addressed with your advisor specifically in terms of the quality of both bonds and equities that you hold, especially if you're looking for income and if you're looking to beat inflation and protect your capital. So again, these are some of the points I just covered with you. So will any of the companies go out of business? Have some of the companies in the process of these economic uncertain times become too reliant on debt to grow and to survive and to take advantage of growth opportunities? It's a very different landscape. And for the ones that do pay dividends, are these dividends truly sustainable? Or are some of these companies borrowing funds at low interest rates to just pay the dividends versus generating these dividends from true earnings? So these are all questions that we need to discuss with our advisors when, especially after a time like COVID crisis. These are some of the criteria we use. Go ahead, Troy.
Oh, thank you. And for bringing out the focus on the paper assets like ETFs, bonds, mutual funds, dividends, and like a store value. And we have a paper assets and physical assets. So in this volatile environment, how do you compare the two types of assets, paper and physical? Physical, I mean like a real estate, gold and silver bullion, and crypto. So, and how do you compare these physical assets and even there's some people as a beginning to store food themselves, and comparing these two types, where should we put focus on now? For example, right. And particularly in this volatile environment, why countries or governments are rushing to print money. They try to devalue their currency. And now the major suffering that we face is that the money value keeps dropping. So the important thing for us is how to keep the value as much as possible of our hard-earned and saved assets or money.
All right. So I could answer that question a number of ways, depending on who the investor is. There are sophisticated investors who understand and are comfortable investing in a very volatile Bitcoin. There are investors who are not looking to their investment portfolios to withdraw income to supplement their retirement income. I would never advise such clients to look at Bitcoin. And so Bitcoin is extremely volatile. At any given day, it can go up or down by a significant amount. And it's very unclear as to how it's going to be regulated or taxed in the future, but it certainly will be taxed. And there's a lot of regulation coming. And so it's unclear as to what the total return after tax will be on Bitcoin. And so we as a firm do not invest in Bitcoin because it's not something that we understand, nor are we able to explain that to our clients. And because of its volatility, we view it as too risky to be invested in. Another parameter that comes to mind if you are personally considering is the time frame. I don't know that anyone will make a lot of money with Bitcoin in the short term, but who knows what happens with that whole theory in the long term. And so for someone who is retired and who, again, relies on their investment portfolio, I would not recommend Bitcoin as an asset type. Again, if you're looking to leave an estate to great-grandchildren and they are technologically inclined, maybe you create a small account for them to play with and watch what happens with as an experiment, but I certainly wouldn't put a significant amount of money there now. As it pertains to mutual funds and ETFs, be very careful of those products. They are more suitable, and some more than others because there's a lot of variety in the market, but some of them are more suitable for people who are just beginning to invest because it's best, it's easy to diversify a very small amount through a low-cost ETF, right? Mutual funds tend to have a little higher fees, so I don't advise mutual funds to any of the clients, and in our portfolios, typically we don't invest in either. Another thing to keep in mind is how many of those products you have in your portfolio, because if you have a portfolio that owns a few ETFs and a few mutual funds, there is going to be layers of fees, and I don't know how efficient it is from a fee perspective for you to own layers of products that invest in underlying securities. And if you have a portfolio that looks like that, I would love to give you a second set of eyes review and tell you where the inefficiencies of the portfolio lie, in that a lot of those products will invest in the same companies. So you may very well be over-concentrated in the same companies and not even know that you are, because you don't see the underlying names and you don't see the underlying risk. And meanwhile, you're being charged 2 layers of fees. And I don't even know if that's being disclosed to you. And so it's important to be aware that something like that may work more efficiently for someone who just came out of university and is saving $300 a month because that's all they can afford. And in that case, it's okay because all their money goes there and it's well diversified. For someone who has more significant wealth they've acquired through their life's earnings or inheritance and whatnot, a more structured and focused portfolio is of value, because in a structured portfolio, that's where you're going to be able to have a chance for your advisor to add their value in selecting the companies that are poised to grow in this environment. They are poised to grow to the extent that their growth will beat the inflation, right? And they will preserve your capital that way. And you own a currency that it's not subject to sort of losing value to the extent that the Canadian dollar may, because it's not held as widely as the US dollar, for example.
I agree. And stocks in many aspects are far superior to ETFs and mutual funds. All these are paper assets. Then how about in terms of keeping value of the currency that we keep? And how about, let's say, real estate? Do you think real estate in this environment is a good investment asset?
Well, if you're looking at real estate in terms of a rental property, is that what you had in mind?
That is a good question. And I'm sorry, I have a doorbell. I have to answer the door and just for a few seconds.
Okay. So these are some of the criteria that we look at in selecting our stocks and selecting our companies and building portfolios that are going to beat inflation or their growth rates. We look for companies that have high earnings and that historically have had high earnings. We look for businesses that we understand, and we see the profits in cash, and we don't necessarily look at companies that have differing accounting practices where the earnings haven't been consistent, and through the lack of consistency, we've noticed that the profits may not have been presented in a truthful way. We look at companies that have businesses where they have the ability to raise prices. Gold miners, for example, or oil producers do not have the ability, telecom companies do not have the ability to raise prices. On the other hand, Ferrari can raise their prices, Amazon can raise their prices, and Google can raise their prices, and so can Microsoft. These companies are the trailblazer in their particular sectors. And so they have that ability, they have that moat to their business where they are unable to get competitors to the extent that the more regulated companies may face higher competition. We look at companies that have more reasonably predictable earnings because of the moat, the access to their business. And we look for companies that are not naturally targets of regulation that will slow this growth and that require little capital investment. So companies that are asset light and companies that have management that is very strong, that has a commitment to keeping a very healthy balance sheet. So Choi, to answer your question with regards to gold.
Sorry, I couldn't hear you.
To answer your question,
I apologize.
To answer your question with regards to gold. You mentioned gold. You mentioned gold.
Oh, gold, right now, and you see, gold is a rushing high, and the silver, and it's a following. And
right.
Some people predict that eventually, and in the future years, the gold would go up to 5,000 an ounce, or even 6,000, because right now we are using fake money, and people have no confidence in fake money. So we are trying to come up with ways how to protect the value of our savings. So right. This is very important to us. So now the fact is, people rush to gold, precious metals, and precious metals are a form of a physical asset. Another form of physical asset is a real estate, no doubt. And rental properties have always been a superior and investment asset. The reason, and you can bring a loan, and then you rent out, and then with a minimum mortgage, and then after 20 years, it becomes your own asset. It's a superior winning strategy to buy and real estate, particularly in this volatile environment. And to keep the value and to prevent inflation, and because of the value going steep down and of our money, should we invest in real estate? But I have heard some arguments that definitely it's a time to say no, no, no. And the reason and number of reasons.
Wait, can we just listen to the presentation first?
I'm sorry. Yes, I apologize.
Well, that's
Yeah,
okay.
if I can just jump in there, we have a number of questions, Esida. I think people are really keen to have them answered.
Okay.
If you look at the, I don't know if you've done this before, but if you look down in the chat, there will be the questions. I think Jackie asked beta and what is a good number? And then somebody else asked, what are the management fees of your company? And is there a minimum portfolio? So if you look down, I don't know if you've done this before, but that's kind of where we post our questions.
Okay, bear with me, please.
Yeah, okay. If you don't mind, I will jump in because people are anxious to have those answers.
Absolutely. So I'm sorry, can you please repeat the first question?
Okay, the first question came from Jackie, I believe, and she was asking about, can you explain beta, B-E-T-A?
Right.
And what is a good number for beta? Right. Some of us may know, but some of us may not. Okay.
Beta is related to the risk in a particular stock and an investment portfolio that you own. So it has to do with when the price of a stock moves too much, either up or down. So typically more stable stocks that are less volatile will have a lower beta. Higher stocks, stocks that move in price a little bit more frequently will have a higher beta. In the investment world, beta is known as risk, and typically companies that have riskier businesses will have a higher beta. Also companies, the stock price moves more and is more sensitive to movements in the overall market, will have a higher beta. I cannot specifically answer a question of what a good beta is because I need to see all of your assets and all your liabilities, and I need to know what your specific investment goals are and being able to tell you how much risk in the market you should be taking. But if your view is to preserve the wealth, so our company will still look to put a portion of the portfolio for all of our clients still into equities. And so beta may or may not necessarily be a concern for us because we are looking at the underlying business of the company. That's what we do our independent research on. And so typically these kind of companies that do have more stable earnings will have a beta that is lower than 1. Typically the dividend payers, and some of the companies we invest in are the Canadian dividend payers, they will have a beta that's lower than 1. Their stocks will be less volatile because they are more regulated. Their business is a bit more predictable for their reasons. So that company will have a bit of a lower beta. Keep in mind, those type of companies may be a little more predictable, but again, after COVID, we have noticed that some of those companies have not recovered as well as some of the companies. Is
Fortis one of those, for example?
Sorry?
Fortis, for example.
Yes, absolutely. Fortis is one of the
So that's an example.
Yeah, so but their stock prices may not have recovered to the extent that the true growth American stocks have recovered, because these stocks are taking advantage of the innovation in the technology world. And so these companies have built earnings and built businesses that are sustainable for the new future in the long term. That growth rate will ensure that our clients beat inflation, can afford to pay fees, and get the growth to support their income. We actually had a client recently reach out to us and tell us how surprised he was that the portfolio that he had invested through one of the main Canadian banks, who he thought was a lot more conservative than our portfolio, did not perform as conservatively as our portfolio did during this crisis, in that when the markets went down, our portfolio held its value really well. He had the equal amount of money on both sides, but the bank's portfolio lost value, even though he claimed to hold quality stocks there. But when the markets recovered, our portfolio captured most of that value. And that's what we mean by the quality of good advice, in that we avoid, by selecting these companies carefully, and these are very large companies, they have been in the business forever. They are leaders in their field. They are taking advantage of the recent innovation. There isn't a lot of innovation in many industries, but the ones that do have innovation, there are established leaders and they are on a growth trajectory, even though those stocks may be expensive now. So those are the type of things. And I have a slide here. I don't know if you can see it. I'm showing you what the technology earnings of the US stocks have done comparing to the rest of the world. Going forward, there's going to be sectors that are not going to behave the way they have in the past. You've got the travel sector, all of the sectors, the consumer-related sectors. You're going to see families are not going to have the levels of affordability, especially the lower income earners. So the spending is not going to be there to support certain industries, such as retail. And you have companies in other industries, especially technology, that are in a growth trajectory. So now, with COVID happening, the world has changed. So it's very important to have another look at your portfolio and see what sectors you're invested in, what companies in those sectors, how innovating are those companies? Do they have a moat in that very few people can afford to do what they do? Are they truly focused on growth? Are they paying you a high dividend? And you have to choose which strategy you're with. But in our view, in the long term, this is how you're going to beat inflation. In terms of the fees that we pay and the minimum we could take an account as low as 500,000 or 600,000. Typically, we get accounts for the entire family. So we'll get accounts from different sizes from the same company, but we will take an account of 500,000 or 600,000 for sure. I cannot tell you an exact fee, but I can email it to you separately if you're interested to know. In that there's a schedule that differs based on the amount that you choose to invest. And so it's a scale, and because also we're a independent firm, we have more flexibility that way. And so the fee conversation is sort of, it shouldn't necessarily be leading the discussion. Our ability to provide returns in the long term is really what long-term growth of investments should be focused on. And so I don't know if there's another question, but typically for a very small account, we will charge 1.35%, but keep in mind, these are personalized, tailored portfolios.
There is a question here from somebody that says, when one is close to 80 years old, how long is long term?
Well,
I think it's from Marlene.
Right. So I would ask you how long your parents lived, and if you're in good health, and if you eat well, and if you exercise. So if the answer is, my parents lived up to 100, I'm in great health, I exercise, I eat well, you may have 20 years ahead of you. And while you may think that or not, the typical question that we tend to get our clients to think about is, how long is the time horizon of the portfolio? So many of our clients would like to leave something to charities that they like to help. Many of them like to support their children once they're gone. Maybe some of them would like to pay for their grandchildren's education. Everyone has different and specific goals. And so we look at an investment portfolio based on the client's wishes and needs. So it may or may not relate to the client's age per se, but I would say 20 years is a long time. And we have many clients that are over 90 that we still have very clear conversations about investments, and they have very specific questions on the stock we hold. And it's science and health has advanced and technology has advanced to the point where many people are living a lot longer than they thought they would. And the worst thing, one of the worst fears based on many questionnaires that have gone out there from retirees is the fear of not being able to afford their care or their expenses, or not be able to leave something for their family, or becoming too reliant on family and children. And so that's where it becomes very important to make sure that you are supported.
So there's another question here. So we have learned that in the past presentations we've had that you should give money to others, for example, our children. What consideration should we take into account when, you know, if you're 80 years old and you really, you could all of a sudden drop dead or get COVID, in order to make sure that we give the children or give charities as much as we can.
So it's very important to have, sorry, go ahead.
No, does that make sense? Do you understand?
Yes, absolutely. That we have these conversations almost every day with our clients. What's important here is to have a will in place that is recent, to have a power of attorney in place that is recent, to ensure that the people who are named in those documents, power of attorney for care, personal care, as well as finances, to make sure that the people in those documents have the ability and the knowledge to be able to help out at that time. It's important to have an estate plan in place. And that's something maybe a financial advisor or investment firm can help with, but it's very important to get these things in place. In terms of transferring wealth, it's important to consider the tax bracket of the person you intend to transfer the wealth to, because there's different ways to do it in a way that tax implications do not become too burdensome. So it's wonderful to have a successful investment portfolio and have enough funds to give to your loved ones. A few ways to explore that, and again, I would have to look at specifics on a person-by-person basis, but a few ways you can explore that is through establishing a trust, and you can speak with a lawyer. I'm not a lawyer, so I can't give you specific advice on that. I lack the knowledge in that field. But a lawyer, perhaps you can benefit, do a cost-benefit analysis in terms of the cost to set up a trust.
You're talking about a bear trust? Are you talking about a bear trust?
A trust, yes. So
no, but there are different trusts.
Absolutely, right? Yeah. So to hold a simple trust in order to transfer the wealth to the next generation, and who you name there and how you name them. So it's important to have a conversation of that nature with the lawyer. Another way to transfer funds is to transfer funds through an insurance policy. So naming a beneficiary in an insurance policy, when they receive benefits, they do not get taxed on those benefits. That's another way to do it. Be careful in naming beneficiaries to your RRSPs and how you structure that, because, so for example, that could be naming a beneficiary in an RRSP becomes more useful when the beneficiary is a disabled person and they're subject to they qualify for and are eligible for all the disability tax credits and whatnot. In that particular case, they could get a transfer without being taxed. But someone who is earning a healthy income will definitely get taxed on that inheritance. So again, it really depends. This has to be planned with your advisor based on your specific needs, but at a high level, and of course you have to consider the cost of each and every one of these solutions. But these are some of the ways we sort of help our clients structure the transfer of their wealth.
So I think that you mentioned at one point high quality equities. Can you give us examples of what you mean by that?
Absolutely.
I wrote that down, and I'm not quite sure. I mean, to me, this is very general. I think a lot of people are quite knowledgeable in the various areas since we've been together for 12 years. So what we think of as high quality companies this is our criteria. So I don't know if you can all see this screen, but this is how we look at determining what the high quality companies look like. Are you looking for me to tell you how we select the companies or what we look for in these companies? Are you looking for me to give you some names? All of the above.
Okay. So we look for companies that have been in the business for a long time. We look for companies that have had high earnings, that are sustainable. We don't see a lot of volatility in their earnings, but that the trend over the long term is going up. Their earnings are going up. And we look at the underlying business. So the underlying business needs to be of a quality where it does not attract a lot of other competitors. We have a company like Microsoft. They are one of the leaders in the cloud space with everyone working from home. That's one of the growth areas, and it's supported by the recent innovation. No one can compete with that. They have a very strong capital structure and capital allocation. We look for companies that do not have a lot of debt on their balance sheets. We look for companies that are continuously innovating. Another company that's a little bit more defensive, because we don't only invest in technology. I just provided that sector as an example that has grown way out of proportion, and for good reason. We think it's going to continue to grow. But Domino's Pizza is another example. They have aggressively grown. They have a very simple cost model. Their pizzas only have very few ingredients, 6 or 7 ingredients. The franchises are growing around the world, is widely available, performed really well during the COVID crisis because everyone is at home delivering, calling up the delivery places, and Domino's Pizza has benefited greatly from that. They have taken advantage of the recent technology, and they're expanding greatly, and their earnings are going to double in the next few years based on their projections of growth. So that's another company that we've invested in. So let's look to see what some of the companies that did really well during COVID are. So Amazon did really well. They are one of the companies that is not looking to create short-term profit. Their profits are not the highest. However, their long-term trajectory, they are becoming the retail industry. No one can compete with their prices, and they bring you everything you want to your door at a very low cost. And so companies of that nature are the ones that we believe will help our clients' investment portfolios grow in the future. And in our view, those are conservative investment because these companies do have very sound management. They have proven to have very stable earnings that are growing through the years. They have incredible opportunities for growth in front of them. And they may not necessarily be dividend payers, but this is the part of the US portion of the portfolio that we will structure the client's account in. Again, depending on the risk aversion of each client and their particular circumstances, some clients may have a higher percentage of their portfolio invested in US equities. But in positioning a portfolio in US equities, we also take advantage of the anticipated growth in US economy. We feel that the US economy will recover much more strongly than the Canadian economy will. And so in investing in US companies, we're also taking advantage of the growth of value in US dollar versus Canadian dollars. And then we also have a portion of those portfolios invested in Canadian equities. And so these Canadian equities, you'll see some of the bank names there, no surprises, but we have selected the banks that are better positioned than some of the other banks that we sold earlier in the year, and which thankfully proved true, especially after the crisis. They've recovered somewhat well, and they have a more solid balance sheet. They have a dividend, which helps with the income component of the portfolio for the clients that are typically looking to extract income out of our portfolio. And so these are some of the things we look for in selecting our companies. And so to answer the question about Baskin Wealth, where I work, typically we've been in the business for 28 years. Our investments in a portfolio, typical Baskin Wealth portfolio, the returns have been over 8% after fees. And so in the course of all of this time, so I have worked in wealth management for over 20 years. And in my view, these are very good returns, especially considering that these are the more conservative type of equities that we have invested in. So we invest in larger companies, large cap. The Canadian portion will also have a dividend component. But in a portfolio, we're not necessarily just looking for income unless we're instructed by the client to create income. We're typically looking for a total return. So we've got the group of stocks that will pay a dividend, but we've got the group of growth companies that truly provides the engine behind the portfolio growth in the long term. And so at the end of a 5 to 7 or 7 to 10 year period, that's where the fuel is going to come from. So it's the total return number that we look to maximize. And the return will look like something just over 8% after fees in the long term.
Thank you. Is that the end of your presentation?
Yes, that's the end of my presentation. The only slide is the very last slide. These are some of I wanted to end it on a positive note. The economic security of millions. we hope will trigger some social reforms that may follow and may accelerate some changes such as remote work, more resilience for households, and then improvement of supply chains. And hopefully with the renewed social contract and an improved income security, hopefully, and productivity will ensue and economic growth will eventually follow. So we hope that even though the recent set of events may have been a bit unsettling, we hope that it has brought to the forefront some issues that need to be discussed and hopefully will be resolved as a result. And that's the end of my presentation.
Well, I want to say thank you, and I just want to go around the group to see whether or not there are any questions. If you look at the bottom of your screen, you should be able to see the chat section, and
Okay.
you can certainly send, your questions into Esida. I will, after the presentation, I will email you all the slide deck, and you can certainly contact her if you have further question. Esida, you need to know that this group of people that you have joined here are very assiduously following everything that is going on. And of course, you may be aware that because we are have been in education, most of us have we have pensions. So we are sometimes talking about money that we have saved or invested, and that's why Choi is talking about real estate versus other things. So, that's kind of the background of the group. I know that people always look for interesting areas that they can explore. And I know also that many of us go back and they will, they will go in and they will research the companies that you may have mentioned.
Well, thank you so much for inviting me, and it's been a pleasure speaking with you. Feel free to reach out to me. My contact information is on the presentation. Should you want me to come back or should you have more specific questions, I'm very happy to come back and answer any other questions you may have in the future. So yeah, thank you so much. And it's been a pleasure, and I look forward to getting any more questions, or if you want to call me privately and ask me about something else, feel free to do that as well.
I think we would be very interested in knowing about transfer of wealth.
Yeah.
It is a topic that we are all very concerned about. And as you saw, there are 80-year-olds and there are people who hold a lot of real estate. And what are they going to do in order to ensure that they don't all of a sudden end up in a COVID ward? And,
right.
You understand what I'm saying, right?
Absolutely. No, I fully understand that. And yeah, no, I would be more than happy to do another presentation based on that. And I could even get one of my colleagues to join me for an additional point of view as well.
Okay. Questions from the group?
Thank you.
Thank you.
You need to unmute your Vala.
I'm unmuted. Can you hear me?
Yes, now we can hear you. Did you have a question?
I wonder about the issue of ethical investments, because, there's been, even with people in politics or people in different situations, it's come up, and when they realize what they've invested in, they sort of say, really? And so I think that might be something that is also a topic that would be interesting, because there can be profits and there can be investments, but sometimes the entire scope of the company isn't well known.
Absolutely.
Very good.
So
I'm marking it down.
Yeah.
And
especially in these times of racism, especially in these times of political you know, support for either other countries or not political support for other countries, or all of those things, as I say, that could be ethical issues, exploitation of communities where countries are located. I have a real problem with outsourcing. I have a real problem when I call for support for Bell Telephone that I can't get that support because the person doesn't understand. And when I ask them, where's the office, I'll drop it off for you because it was a business issue, they tell me they're in the Philippines, but they can't help me because the other person that worked on it is in another country. And I have problems with that because they're being exploited. And in some ways I'm being exploited too, but that's a whole other issue.
Fair enough. Other questions? Okay, see, go ahead.
I know I was going to say, we'll wait for the American election too. That's see if that's going to make changes as well.
That's a very important issue. What can happen if there's a huge blow up with the American election? I mean, they talk about the fact that Trump says he's not going to leave and all that kind of stuff. I mean, is there the potential for real unrest if that, you know, I mean, what's happening in terms of business? Are they even thinking about that? Are they thinking about what that may cause in terms of the political instability of the major country of the world?
That's right. That's you, Varla. It's Joy speaking. Remember me? Joy Holland?
I think so.
From the Adult Day School?
Yes, yes, of course, of course.
So I appreciate your insight to the American election. I think that is going to be something that we should think of as well.
Yeah.
But in terms of the American election, is any government in the year of the election will do everything in their power for the economy to be a bit more prosperous. So in that particular instance, both governments of both Canada and the US are going to take every step possible to ensure that at the very least the stock market is doing well. So they'll do everything in their power that in the year of the election, everything goes well.
That sounds very reassuring then in any case.
Well, that's the expectation. And typically, historically, that's what tends to happen. And there's always a reason behind that to be reelected.
Yeah.
And then in terms of what happens if Joe Biden gets elected. Typically, when a Democrat gets elected, the stock market may experience a very slow drop, but we anticipate that he too will want to be highly aware of the economic uncertainty COVID has caused in the US. And so it makes sense that he will be more interested in supporting economic growth, and he will be supportive of Wall Street and the stock market in an effort to not erode more wealth out of the investors. And so we feel that that will be positive for the markets. And because the markets, the odds now, if you are reading the news, are in favor of Joe Biden, then market is always anticipating events. And in looking at the strong performance of the stock market, one would say that that news has already been built in the markets.
Uh-huh.
You know, I was thinking more along the lines of, I mean, if Biden is successful and Trump says, I'm not going, and we have a unprecedented upheaval, if you want to call it that, in the US, is that going to cause a major issue? The other thing is that, I mean, today I'm a big basketball fan, and, you know, the Raptors aren't playing, and there's the boycotting of the NBA and all that kind of stuff going on. And, you know, there's the whole aspect of political action becoming more realistic rather than t-shirts and slogans and whatnot. So that's why I ask about the issue of, you know, examining companies in terms of their ethical commitment. And, you know, that power could leave the streets and enter the stock market.
Yes, and I mean, that's certainly a concern in terms of if Biden were to win the elections, what does Donald Trump do? Does he leave quietly? Probably not, knowing him and what that means. But, you know, we hope that the cooler heads in the Republican Party will prevail and and there will be a solution that is more peaceful. But I mean, it certainly has brought, there's a lot of social unrest.
Definitely.
Developments, and hopefully all of that leads to some resolution.
You know, I know a lot of people, and I know that Ford talked about this when he was angry with Trump for, you know, the aluminum issue. And at the local supermarket that I go to, which is just a No Frills, there's big signs, Canadian and US, so that you have your choice. And I mean, you know, very much Rob Ford was saying, you know, buy Canadian. And I've noticed, to be quite honest with you, that when I shop even for produce, okay, I will see hardly any left of the Canadian products, and the American products look untouched. So I'm just curious, as I say, this is just in a supermarket, but is this going to affect in other areas? I know that you know, have the comment about buying the country that offers the best investment as opposed to your home country. But where I live, which is York Region, I find that in the local supermarkets, people are definitely, in terms of produce and in terms of products, very much buying Canadian first.
Well, that's encouraging.
And almost protesting and not buying American. So it's kind of an interesting...
I mean, I would love to see the equivalent of Amazon emerging in Canada. I would love to see that. But
well, maybe
don't we have Shopify?
Well, we have Shopify.
Yeah, and I'm not necessarily sure that Shopify has had sustainable long-term earnings. In our view, that's more of a company where everyone has bought in with intent to not miss out. And so our view on that particular company is that it's potentially a little bit too overinflated, and the underlying fundamentals of the business do not support the price point it's reached. And what we call that in investments is home country bias. Keep in mind, many of you probably own real estate. That is part of your investment portfolio. And
I know we talked to somebody recently, we belong to a golf course, and he has a condo in Florida, and he was telling us that we should think about buying one, because he said there's $1 million condos going for 500,000 and there's 500 for going for 250. He said, I've never seen anything like it. Everybody is, partly it's COVID, and people are just saying, I'm not living here. A lot of Canadians are selling their condos in Florida. And this is just this is just a story from, you know, being at a golf club and talking around the pool. And he said, I've never seen anything. He says, I'm not selling mine. And he says, you should buy and come down there and be with us. So he's supportive. And again, I'm not necessarily taking a political stance myself. I'm just telling you stories I've heard and from people. And
the other concern is the border crossing, which is still, we're very sensitive to it here in BC because of the Americans. And how long is the border going to be closed? That's going to be another issue. Yeah. We have people here who are in the States presently, and they cannot come up to British Columbia, for example. So ideally, if you want to buy something in the States, I think you have to think of your mobility too.
Yeah.
Absolutely. So it becomes part of your long-term investment portfolio, because to buy real estate and to sell it and to pay all the taxes, this is not going to be easy. So those funds aren't going to be liquid. So those better be funds that you've set aside for a next generation.
Good point. Good point.
So I'm just wondering about this Florida business. I know that some of our members have condos in Florida, and I'm wondering whether or not it would be suitable to have a presentation on the perils of and implications of buying and selling a condo. I know that in the past we've had people come and talk to us a little bit about that, but it's about 4 or 5 years ago. And I know that some people have already sold a condo, and it's a very complex process. I don't know what the group feels, but that certainly would be a very interesting topic. I don't think any of us are going to Florida this winter.
No, sadly.
Well, I think the other thing is that some people have condos and go down and visit with family and friends for a short period of time. but use it as a rental property for the rest of the time. And with COVID, I think that that's really gotten into a whole other thing. I mean, it's the same as what's going to happen to Airbnb. I mean, because I mean, there's the whole disease issue and are they clean and this and that and everything else. So
it's a complicated issue. I believe.
It's a complicated, yeah, it used to be, as I say, that people, you know, had a rental business going on, you know, and had clients that were willing to come and rent. Now with the travel bans, well, travel issues about quarantine, with the whole idea of, is this condo clean? Has anybody been in it that has COVID? I mean, there's so many questions. So I think that that whole market of having a retirement condo that at the present time you're renting out through a good part of the year is kind of not happening. And then you're left with the maintenance and the mortgage and everything else all of a sudden, so.
Well, it's important to keep in mind that at these times of pandemic, with the public subsidies that have been in place and the deficits that the governments are incurring, there's certainly going to be an emphasis on collecting future taxes. And so in the future, you know, we probably all are of the view here that taxes have nowhere to go but up. And what happens to capital appreciation taxes? You buy a condo in Florida, there's fees and costs to purchasing such property. When and how can you access it? That as an investment is illiquid in that you won't be accessing its value if you ever need those funds. And should you want to sell it, how much of that capital gain are you going to hand over to all the governments? And also, I've read about clients who, even once they sold their condos, they then put all of their wine cellar into a truck and shipped it to Canada, only to be stopped at the border and charged again there.
Yeah, they get you one way, either coming or going, they get you.
I mean, there's all these costs associated with that as an investment. So I would caution someone, especially when considering time horizon, if you're looking to buy something at a low price that is a good property and you want to leave it to the next generation because they will use it eventually, that's one line of thinking. But I'd caution and other investors to view that as an investment property, especially in times like these.
Yeah. Thank you.
Okay, are there any other topics that you would like to explore?
I'm
waiting.
The passing on the wealth loan, the one that you mentioned, transfer of wealth.
Well, I transfer of wealth.
I still think that that's something, there may be angles we haven't thought about and maybe good to know.
I like that.
Yes, I agree.
Okay.
Mm-hmm.
On
the other side of the coin, what about transferring debt?
Oh boy.
We have debt?
Okay. Do you hear me, everyone?
Yes.
Good. And if I'm allowed to join and to jump in, and back to the real estate, allow me to say what I really feel. It's time not to get into real estate. Wait until everything drops to the bottom. Many facts.
Never happened.
The crash coming, so don't go in. And also I like to go back to the value investing. And it's always the key corner of investing strategy. And Coca-Cola, Home Depot, McDonald's, all those great stocks. But the one question, the back is true and Esida. And in 2008, and when the whole market collapsed, and anyone started and value investing or any stock investing at that time, all along 12 years, made wonderful, wonderful gains. But now it's 12 years. So for those people who now and still insist on the value investing, I think like a plan B is needed now. And in case like after 12 years, you know, nothing can anything can happen. But then I really enjoyed the presentation. It was great.
Thank you. I thought it was good too.
Yes, very good. Thank you.
Esida, I'm conscious of time and I don't want to keep you any longer than necessary. There may be some of us who wants to chit chat after the presentation because we don't have a chance to see each other.
I know.
And you, the group should also know that when we had our in-person garden party, there were 5 of us that were actually 6 by the end, and we were all sitting 2 meters apart, and we really could not stop talking.
Oh, that's good.
In the end, I said, let's order pizza. And they said, oh my God, we got to go home.
Oh, I'm sorry I missed it. I'm sure it was good.
So
lovely seeing your faces. And thank you so much for being so patient and allowing me to go.
You're welcome. And thank you again.
Esida.
I'll be in contact.
Thanks, Esida.
And I will send out the slide deck you gave me. So thank you so much, Esida, for joining us. And if there's anybody has any leads, did you find somebody for your children?
No, I haven't found someone yet for my son, but I'm still looking.
Oh, okay.
Thank you for your help.
All right.
Thank you. Take care.
Thank you.
Bye.
Thank you.
Bye.
Thank you, Esida.
Thank
Bye-bye.
Bye.
So for the rest of you, if you so feel, we have to look forward in terms of the group, and I have to thank Merv for being so kind to always host us. And allowed her. So thank you for that. You know,
thank you, Merv. Thank you. I would join your other meetings, but they're too early for me. You start at 10:30. That's like 7 in the morning for me. So sorry I can't join you, but thank you for including me.
So just for your information, our next Zoom meeting will of course be in September. And I am going to send this out to everybody. And I have also been in contact with the executive. And I will send all of the dates in from now until Christmas. You are more than welcome to join anytime you wish. And if we have to, after I'll ask you whether or not you want to have an in-person meeting. So for September, it will be the 24th at 4 p.m.
Okay.
That's Eastern Standard Time, of
yes.
course. And we are still under the Zoom cloud, if you want to call it that. And it seems to work for us. I know that there are other districts who have gone ahead and they have all kinds of other activities that are, but I think for Toronto District, so far we are leading the, we are leading the parade, so to speak.
Oh, good for you, Lone.
So if you can mark it down in your agendas, and then October will be the 29th of October.
Yeah.
Again at 4 p.m., provided that we are on Zoom. We'll do it at 4 because of the time difference for some of you. November will be the, it'll be the 26th.
26th?
Yeah, 4 p.m. And then December, we usually have a party, as you know, I don't know what you want to do with that, because that would be the 24th. And of course, we can't do it then. We could possibly do it if we're still under Zoom regulations. We could do it on the 17th. And if we can do anything in person, it's at my house, and we serve wine and cheese, and we sing to our heart's content. We have our Christmas concert then, and Joy leads the parade for that one. And we start at, yeah, well, do you think you'll be back by then?
It's all COVID depending. What can I say? If there's a good flight that's sickness-free, Malone, I'm monitoring it on a fairly regular basis. It has not been good regularly.
Okay,
in
if
recent
you are coming
flights.
back, let me know, and we'll get together.
I'll let you know, for sure.
And so the Christmas party will then be on the 17th, wine and cheese, and if it's in person, it's at my house.
Woo, lovely.
I will
Thank you, Lone.
Yeah, we always have people who can play the piano, and people who, I think we had the ukulele last year, didn't we?
Yeah, our festive spirit. I remember singing all the carols and things. It was good.
Yeah, so I will send that in to the executive for the newsletter to be published. The newsletter will be a little late, I think, because they're still, working on it. And then, but I'll make sure that all the dates are sent out to you. And
Thank you,
as well
Lone.
as the slide deck. You're welcome.
That's very kind.
Lone,
of course, yes.
can you hear me? It's
Yes,
Jackie.
Jackie.
I just wanted to thank you for allowing me to come, because it's a long drive for me to go to your house or one of your venues. And I said to Lone, this is marvelous, because I know there's the odd pocket of people in other districts, and we have to learn to open the door to everybody. If you've got a great idea like Lone has, I'm sure there's others that would be interested in joining a Zoom one, even if you don't do the Zoom every month in the future. But once in a while, if you've got a great topic, I'm sure the trust one, and leaving your money for your children and not just in cash. Look at him, who's this? That's waving at me. Anyway, I think it's wonderful. Are they all your district?
No, we have, I think, at least 3 or 4 districts represented at this point.
Wonderful.
Merv is from North York. I'm not sure. Vernon is from North York. Marlene, where are you from? Are you Toronto?
Yes.
You're Toronto. But I'm happy you joined us, because I don't think you have been with us before, but you're welcome anytime.
I went to the one. I went to one when I was already in Toronto for a liaison with your Toronto district. But yes, no, I'm always interested in this stuff.
Okay, Vernon has something to say.
Quick question. The September meeting, I think you said Eastern Standard Time. Aren't we still on daylight savings time then?
Oh, that's a good point. We may be.
We may be in
September.
Yes, we are. Sorry.
Yeah.
It was more for Joy, actually, because.
Oh, that's so thoughtful. I'll have to remember that.
Yeah.
Well, you let me know when you get the meeting. We'll be in touch, Alone, before then anyway.
Okay.
For sure. I won't miss it.
Okay.
Hey, Vern, I think it's still considered EST, even though it's daylight savings time. Part of the reason for that is, there's daylight savings time across all of the time zones in North America and probably Europe. So it defaults to the time zone that you're in.
So it's standard daylight savings time.
Yes.
Okay.
No, it's EST.
ESDST.
I think we're on RST. We're on retirement savings time.
Good point.
Well said. Is there anything any of you need or we can do for each other? You all have my email, and you're more than welcome to give me a ring or call. There are some of our members I have emailed back and forth with that have not gone on Zoom. And if any of you have a chance to give Jeff a call, he, like me, he has a heavy caregiving load. And I've spoken to him a couple of times. And so the last point I wanted to ask you is whether or not anyone are interested in having an in-person, in-garden get-together.
Wow.
Mm-hmm.
I'm willing to host if you want. And if that's the case, then we need to have a look at the date. But otherwise, we will stay on Zoom.
Fair enough.
Yeah.
Okay. If you don't feel that that's good right now, I can tell you, I spoke to my sister in Denmark this morning and she said, man, it's broken out in the town that she's in and the kids have been sent home from school.
Oh my.
Yeah, so
Wow.
I think we're not through yet.
Yeah.
You know?
No, there's a lot of anxiety with all the schools everywhere.
Yeah, no kidding.
It's going to be a hard re-entry for September, I think.
Yeah. Well, $2 billion is not going to alleviate the anxiety.
No, you're right, Lone. Yeah.
Lone, have you noticed that there's more people interested in retirement coming to workshops and whatnot? Because I know I have some colleagues that are still working and, you know, teach people that I've stayed in touch with that were teachers that were in my schools because I was a vice principal and a principal. And a couple of them I've talked to and they're really considering retiring. They can because they're, you know, at the border kind of thing. And I'm wondering if you're seeing that there's a lot of people that are making that choice to not return, but to retire.
I can tell you in the East area that I belong to here in Etobicoke, there are 4 of the superintendents that have retired within the last 4 weeks.
Wow.
And
Oh,
that,
boy.
of course, just, you know, it starts there and then it goes right down the, you know, the ladder, so to speak. So if you have friends that are interested, they can certainly attend the RPW, the retirement workshops. They are now online and they would have to register with the central office. And Stephen Wong gives them, he usually does a very good job. Although the local one, they used to hear from Sheila Tate and myself when we introduced the 4 districts, but we don't have the opportunity to do that at this time because people are coming online from everywhere. But you can let them know and feel free to give my phone number and my email. I'm more than happy to chat.
Thank you so much.
You know.
Thank you.
I'm just curious.
Oh, all right. Well, it shows participants somewhere.
Somebody said they were curious. Who's curious?
Mike wants to know why he can't see himself on the, maybe it's because when you look at the list of participants, if I click on me, my name, I guess, does that show?
It's up there.
Mary Corda does it.
And thank you so much, Lone, for setting this up and for being, it's the first one I've been to, but it's very well done. And, you know, the information is excellent and sending the slides ahead, you know, that's going to be great. So thank you so much for all of your work on this.
You're welcome.
Maybe it's that pin video rename.
Oh, Lone, just for humor. I looked up Domino Pizza just to see what the price of. I don't know anybody else knows. Over $400 US. I think it's a little out of my price range. So I thought I'd look at Pizza. It's a little cheaper.
The other thing is also when you invest in the US stocks, you have to take into consideration the exchange rate.
Exactly.
Yes.
If you are converting from Canadian funds into US So I personally stick my US account. I reinvest in that. I have actually taken some profit. I wasn't going to tell her that, but I'm sitting on quite a bit of cash right now. And there is a purpose to that. But when you then convert it back into Canadian funds, you have to take into consideration you have a 25% difference. So.
And then there's a withholding tax too, right?
That's right.
Don't forget.
Yes.
Interesting. My girls group, we have it in our policies that we don't invest anymore in US because we got hit with the tech bubble, and we had Microsoft way back when, and we lost a lot of money. So our portfolio is no longer allowed to buy anything in the US. We only buy Canadian.
So Jackie, just for your information, we don't invest as a group. We are each responsible for our own, our own portfolio. I think Mike Corda had a comment.
Oh, no.
Or has he left?
Okay.
There you are. There's Mike.
You are.
Hey, Mike.
I don't know what I did.
I've been sitting, quietly till I got my secretary to put me on the screen. Anyway, the forecast is talking about US dollar. They say the US dollar, of course, a lot depends on a lot of things. They say it's going to strengthen. Our Canadian is peaking as far as it goes. So I'm in a part, this is my personal opinion, I'm holding US and converting Canadian cash to US as available. Yeah, like I say, and the prediction is that our Canadian is it's over 76 cents, and it's pretty high. The loonie is flying high. That's
right.
Wow. Possession, and that's my feeling.
Are you converting using Knightsbridge?
I'm converting Canadian to buy US.
Yeah.
Are you using a bank or Knightsbridge?
Oh, well, I have different accounts, and I can do it through the wealth. I do it through the wealth management, the Scotia, or RBC, and they're pretty reasonable.
You pay a higher rate than if you
no, much less than the local branch. But you have to change. I think you have to change $25,000 or $30,000 at one time. You can change $5,000.
Change 2,000 at a time.
Right.
So could you send that out?
But I don't. You need to have an account with them. You see, you have to have an account.
Sign up online.
Yeah. No, I don't do it online. I do it old-fashioned. Can you hear me?
Yeah. Marlene, can you send that to me and I'll send it out to the group?
Well, I could send you the information, but the problem is that you have to have an account with them, and the account has to be like $500,000 to $1 million.
Not with Knightsbridge.
You need a large deposit.
You open and
you know what I'm saying?
Yes.
Yeah. That's the way. But there is some other. I can research it. I can give you some information. There's some other people. They do it, but you still need to change a large amount either way. Sell Canadian or buy US.
So Marlene is going to send the information around Knightsbridge to me, and I will pass it on to the group. How is that?
Okay.
Marlene, where are you?
Thank you.
I just want to add something to what Marlene was saying. I've been using Knightsbridge for the past 4 or 5 years. I found their rates, some of the best in Canada. And I've never stepped into any of their offices. Setting up an account is, you call them up and they give you an account number and that's it. They don't have any money of mine with them. Anytime I want to make a purchase, any currency, I just tell them how much I want to, and it's typically as little as $1,000, and they'll give me a quote and send me an email, and I just have it transfer from my Tangerine account into Knightsbridge, and within 2 or 3 days it appears in my US account or wherever I choose to have it. I've had an excellent experience with that, and I'm glad that Marlene has too.
Good to know.
Can you send that information?
Yes.
What's the name of the company you're using, Mervyn?
It's called Knightsbridge.
Which?
Knightsbridge.
Knightsbridge.
Like K-N-I.
With a K?
Oh, with a K. See it? Do I need to see it?
Yeah, okay. That's good.
Mike, I will send it out when I receive the info. Okay, I'll spread it out to the entire group.
Thank you. Okay.
Because I just transfer it out of my investment account to Knightsbridge in Canadian, and they send it back to my investment account in US.
Oh.
It's easy, and it's cheaper than the bank's rate or the
Wow.
brokerage's rate.
Good to know.
Good to know.
Good stuff. Beat the bank.
I have another specific question. What does anybody think about the Apple 4x split that's happening on Monday? Is that something that any of you would think of buying? Because it's going to be the price will be divided by 4, because people who hold it now will get, they have 100 shares, they'll end up with 400 shares, but the price will be lower, so it'll be more easy to buy.
Sometimes that works and sometimes it doesn't. I'm waiting for the split. And what I do is we bought the weed stock, and it went crazy, went really high. I sold half. So whatever happens to it now, I'm still good to go. I might buy some more when it goes, but I'm going to sell off most of mine and keep 100 shares, and I'm letting the rest go to make some money in my account.
Exactly.
So I'm doing a happy dance right now.
Okay.
That's good
So
advice.
it's supposed to happen on Monday.
Monday, yeah.
Are there any other thoughts at this point? Okay.
No, thank you very much, Lom.
You're very welcome. No, thank Merv.
That was good.
Oh, thank you, Merv.
Thanks, Merv.
Thanks, Long. Thanks, Merv.
Thank you.
I will.
Thanks,
Thank
Merv.
you. Have a wonderful night, all of you. And if you need us, do stay in contact. Okay?
All right. Take care.
Thank you. Good to see everyone again.
Absolutely. We miss you all. Bye.
Yes, we do.
Thank you, Lone.
Big
Thank
hug.
you.
Bye.
Bye.
Bye-bye.
Bye.
Bye.
Bye.